Good morning, everybody, and welcome to today's meeting of the Local Pension Committee. As usual, this meeting is being broadcast live to the public. For those not able to watch live, the webcast will be recorded and made available for viewing on the County Council's website after the meeting. Before we begin, can I please remind everyone to only turn on their microphones when they wish or are invited to speak. I know we have received apologies from Mr. Vikul Bakar, Mr. Clive Pitt and Councillor Martin Cartwright. Now on to the main agenda items. The minutes of the meeting held on the 6th of September 2024. I propose that the minutes of the meeting held on the 6th of September 24 are taken as read, confirmed and signed. Is that agreed? Agreed. Thank you. Item 2, question time. I have received no questions. Item 3, questions asked by members under Standing Order 7.3 and 7.5. I've received no questions. Item 4, to advise of any other items which the Chair has decided to take as urgent elsewhere on the agenda. I have not been notified of any urgent items. And item 5, declaration of interest in respect of items on the agenda. Does any member have any interest they wish to declare? No? Okay, on to item 6. The first substantive item on today's agenda is the 2025 Valuation Principles Report at pages 19 to 54 of the agenda. We have with us Ian Howe, Pensions Manager, who is presenting the report. And I'd also like to welcome Mr. Tom Hall from Hymans Robertson, who has joined us online. Ian, please go ahead with your presentation.
Thank you, Chair. Good morning, everybody. This is the next stage of the valuation. So we're working through the valuation cycle. This is setting the valuation principles. I don't propose to go through the report line by line. I'd rather pick out the key points and then any questions at the end. As you know, the position is improving in terms of the funding. We did the broad estimation at June time and it improved to about 150%, previously 105 at the last valuation. So you can see the direction of travel is positive. The purpose of this stage is to set the principles. And the areas we want to ensure we cover are looking at the employer contributions for the stabilised employers, the target funding level, which is something that we introduced at the last valuation in 2022, look at the prudence level and the investment strategy, and maintain the 1 at this stage with a further report to come back looking at that in more detail as we move through. So this is looking at the stabilised employers. The stabilised employers are the larger ones, the councils, city, boroughs, districts, districts and police and fire. The stabilised employers have a smoothing rate. So when times are bad, they don't pay quite so much, but we move it up. And when doing so well, we gradually move it down. So there's that smoothing effect. And we wish to keep the smoothing. The smoothing rate allows for a 2% increase or decrease per year, so up to a 6% change over the 3-year cycle. For the target funding level, we introduced that, as I say, at the last valuation, and we targeted 120%. So the purpose of that was to kind of build prudence into the rate. So when employers reach the 120%, then we look to offer reductions to rates rather than at 100%. We propose to keep that this year, and that's detailed in section 18 of the report. We also propose to increase the prudence. At the last valuation, and we adopted a 75% prudence on the investment returns. We'd like to increase that up to 80%, but to continue to keep that under review. That would mean that the fund would assume a lower investment return when setting funding plans, which helps to mitigate investment risk. There is still obviously a 20% chance of not making that with a 80%, but we believe that offers that greater level of prudence as well. In terms of the investment strategy, we only have the 1, and that's what we propose to keep. But as I say, we'll look at that in more detail and provide another report on that next year. Now, what I would say is by keeping the 120, increasing the prudence to 80%, we are very conscious of the employer rates and the stabilised 6%. We believe that by targeting that, we will still be able to offer the 6%, so the maximum over that period, by still increasing the prudence to 80 and keeping the 120 buffer. So we're in a good position. That's what we're targeting, and that's what Hymans are going to be working through. And then we'll have that information ready for March next year, which I'll then be able to bring back. That's all I propose to say in terms of the report, but obviously happy to take any questions, and Tom's here from Hymans if we need, any questions for Tom as well. Thank you, Chair.
Okay, so this is a very usual standard valuation principles in maintaining the contributions to the fund and where we want to be. Has anybody got any questions or queries? Jeff?
Thank you. I support the proposal to increase the prudence to 80%. I just wonder, this is for the fund rather than the pool, is it? And if it's just for the fund, I just wonder what the position is being taken by the other members of our pool, and across the country generally, what is the average sort of situation? Thank you.
Yeah,
Yeah.
Yeah, I think the fund actually invests in the pool. What I'm uncertain as to what the situation is across the rest of the country.
Can I ask
please.
Hymans, because I'll be absolutely honest, this is our fund, as you say. The wider, I'd have to ask Hymans for that view. Is that okay?
So, welcome, Tom. You've come at a very timely moment, a very awkward question. So, over to you.
Thank you, Chair. And apologies, I can't be there today. I might see some of you at the upcoming AGM, and I believe I'll be down at March as well. So, look, it's a really good question around the level of prudence. Prudence is an interesting one. So, the regulatory requirement for pension funds is to set prudent assumptions to make sure that we're protecting member benefits. However, there's no sort of golden rule as to how prudent is prudent. Okay, so it's a little bit of a subjective call. So one of the good questions is to ask is the one that that's been asked today is what's the context in the LGPS? What are other funds doing? It's a useful guide. So I think historically funds, I'd say for quite a long period of time, most funds have sat somewhere between sort of 70 and 80. Okay, probably the majority of the LGPS were towards the lower end of that scale, maybe 2 or 3 valuation cycles ago. There has been a gradual sort of ratcheting up of that prudence level, and a lot of it is in response to improving funding positions, improving market conditions, but also increasing market volatility. Okay, this increased uncertainty about what's in the future. So probably where the fund sat last time at 75%, I would say would be middle of the pack. And I would say now most funds sit around 75 to 80, and early indications suggest that the majority of funds, particularly those who are at 75, will probably make this jump up to the 80% level at this valuation.
Okay, thank you, Tom. So, any other questions? Right, James.
Yeah, I was going to ask the same question really around the level of prudence and what's the kind of the rationale for that, because obviously we're in a relatively fortunate position at the minute in terms of funding level, but I guess the underlying assumption should be based on the right things, not because of where we are, if that makes sense. But you've answered that. Thank you, Tom. Just following on from that though, in terms of the 120% funding level, does that not double insure effectively? So we've got a relatively high or increasing level of prudence, and we have the 120% funding level target. Is that not double insuring?
Yeah, I'm happy to take this one again, Ian, if that's okay. I get all the tricky questions today. The short answer is yes. Okay, it's a good question and it's a good point and it's a valid point. It doesn't mean that you're wrong to doubly insure. Okay, it's just different ways of sort of justifying and rationalising prudence. The way that I tend to think about it with the 80% or the level of prudence in your overall assumption set, that's more to do with the future investment returns, market uncertainty. You could even put it down to modelling risk. Okay, look, we as actuaries, we set up these very sophisticated models, but they are ultimately just that. Okay, they're models, they're not crystal balls. And as you get increased market uncertainty, and particularly given what's happened in the last couple of years, that there'll be certain commentators out there that might say, well, interest rates will come down quicker than what we expect. Equity returns won't be as good as what we expect. So I think that there would definitely be rationale to support maybe a little bit of increased uncertainty there. Okay, and that's fine for prudence, and that's probably the justification that most funds are going to take. On the 120 level, a couple of things that's important to remember. So if an employer leaves the fund and they get their funding position calculated for an exit position, it's only calculated based on 100% funding. Okay, we only want employers to be 100% funded. We're not asking them to pay more than they need to pay. The 120 is more of a kind of target level to manage future volatility. And it's not just for the fund, it's for the employers as well. Okay, it's essentially a cushion against other things that are maybe harder to predict. Probably one of the most obvious ones that you'd point to would be climate risk. Okay, which is actually more of an uncertainty than a risk. Risk as actuaries we're comfortable with. We can sort of put a number on it. We can attach assumptions to it. Whereas uncertainties are something that's a lot harder to quantify. So, and that's just one example of it. So yes, it's double counting. You could argue that. You might get an employer that argues that, but I think the fund is fine to rationalise it the way that we're proposing to do so. It's already been in play as well since the last valuation, and going back to that point, that crucially it's not a way of asking them for more money. It's just a way of managing their own pace of funding over a longer period of time.
Thanks very much, Tom. Declan.
If I could just add to what Tom said, sort of briefly, if you think of it the other way, if we target 100%, the fund's systematically always going to be underfunded, which kind of as individual employers puts in an uncomfortable position, because if something happens, an employee leaves the scheme, actually everybody else has to pick up the tab. So the 120 does something that I suppose is a bit more effective than I suppose just a layer of prudence. It is kind of helping with that sort of good management of the fund and taking the risk off individual employees from another unrelated employer. Sort of a problem happens. So it's kind of it is good practice as well. It just elevates that risk and sort of takes it away a bit as well.
Thanks, Declan. That makes sense. Has anybody else got any other questions? Yeah, Nick. Oh, sorry. Bill.
Thank you, Chair. Apologies for my slight late arrival. Got stuck in the traffic. What I was going to ask about is this. I've listened very carefully to what's been said. I'm kind of thinking, okay, so this what you call the stabilised employers, which are the main principal councils. Now, not all of those are currently in surplus. So what impact does doing something like this have on those employing bodies that aren't currently in surplus with the fund? Because some of them, I'm aware, are in deficit. So does that have an effect on their ability to catch up with that deficit to achieve a fully funded position? i.e., are we going to go to them and say, actually, you've got to put more contributions in because we're seeking in effect, lower return? Does that make sense? So therefore, we're actually putting more pressure on some of those stabilised employers, as you call them, which I expect isn't what we're proposing to do. So I'm just trying to wonder what this is actually going to actually end up achieving for some of those employers who aren't necessarily in surplus position. Obviously, we don't have that data in front of us either. So,
I'm happy to take this one again, Chair. Or I don't know if Ian or someone else would want to step in first.
Yeah, Tom, you go ahead first, and then we'll ask Ian if he's got anything to add.
Yeah, thank you. So, absolutely valid question, and I think Ian touched upon this during his presentation, where it's critical for the fund to strike this balance between protecting the fund, protecting the employers, protecting the other employers, as Declan's pointed out as well, but crucially as well, protecting the employers in question, the stabilised employers, and not particularly that group. We know the challenges that group are facing just now on affordability and budgets. Probably the simple answer to the question is that actually they are all now in a surplus position. Okay, and whether or not you call it surplus or they're sufficiently well funded, this surplus is only really relative to the assumptions that you set. Okay, but certainly last time it'd be right to say that some of these employers weren't quite 100% funded. Just the way that the markets have been since the 2022 valuation, I would expect most of them will be sitting around there or thereabouts the whole fund position. They're quite similar in liability profile and membership profile. So I think at the last committee we were down and we were presenting a funding level of the fund at 150%, which is significantly higher than it was at 2022. There's also some stuff in the report today that talks about if we're to move the level of prudence when we're talking about the future investment return down to up to 80. It would depress that funding level a little bit, but it would still be around 135%. Okay, so what I'm saying is the majority of the stabilised employers will probably be around that mark. Okay, and I would expect them all to be above 120. The other answer to the question is probably getting ahead of ourselves, and I would maybe defer this to the March committee when we'll be bringing the results of the contribution modelling exercise that we're carrying out. And there's a lot of detail in there about the quantitative factors that we're talking about today, but also the qualitative factors around affordability, intergenerational fairness, not wanting to put pressure on councils to then have to put rates up in the future. All of these things that are equally as important as the actual as the data and as the numbers. So hopefully that's okay, and it's not too much of a kind of kicking a can down the street till March. There's a lot of really good information that will be coming to the next committee.
Yeah, no, thanks, Todd. I think that's a fair point. Ian, is there anything you want to add? No. All right. So, have we got Nick? Nick.
Thank you. Just queried, actually, the 150%. I'm not convinced myself. I think Tom refers to modelling risk, and I think sometimes these models get ahead of themselves. So I support the report. I think the report is sensible and prudent and reasonable. And when things go up, they go up slowly to stop the councils getting absolutely hammered. And when they go down, they should go down slowly to manage it in the same way. So I support the report, but a couple of things. 8% equity return from UK equities over the next 20 years. Not convinced. That last 20, since the millennium, I think the whole of the FTSE has gone up less than 20%. That was 24 years ago. Inflation at 2.5%. Demographics are terrible now. The collapse in the birth rate is one of the sort of things that are going to really impact on us over the next decade or so, and further on. Government borrowing is high, populism rising. Do you see governments controlling inflation and outsourcing everything to China to keep inflation down over the next 20 years? Not convinced myself. I think those risks are very, very high myself. So it's just to say that I'm not convinced of that 150%, and I think we do need some cover to stop coming round in a few years' time saying, oops, things have gone worse. Councils need to put more money in their pockets. That's my comments.
Thanks, Nick. I think that just illustrates the number of uncertainties there are and why we're at the level and what we're doing, why we're doing what we are doing. To be frank, it's extremely difficult to predict the future, and this seems to be a prudent approach and sensible approach. Has anybody got any other questions? Roy?
Yeah, not a question, just to support what's just been said. I can't buy the idea of only 2.5% inflation with all the upheaval that's going on. I think that's grossly out of line.
It's very difficult to comment, but I absolutely understand what's being said, and really, it is, as I said before, taking into account the numerous risks there are. This isn't a bad way to proceed. And in March, we'll have more information. We'll also know how inflation is running along. But predicting the future is impossible. And that's why we have the actuaries and the modelling and the professionals to do it. And yeah, I take on board what everybody has said, and yeah, it's a very uncertain atmosphere out there, and this seems a fair, balanced, and rational approach to take. So, if we have no other questions, thank you for your answering the questions, Tom. The committee has been asked to approve the following. A, to maintain the current stabilised approach for the employers deemed lower risk, to maintain a higher funding level introduced at the 2022 valuation, and to increase the prudence level to 80%. I'm happy to remake the recommendation. Can I have a seconder?
Second.
Thank you. All those in favour? Right, that's unanimous. Thanks very much. Thank you, Tom. Thanks for attending today. You're welcome to come listen to the rest of the committee meeting, but you may have other things to do.
Yeah, thank you very much. I will listen to the next item is of particular interest to me, but I might drop off after. Thank you all.
Yeah, no, thank you. So the next item is item 7, is the Mansion House proposal reported on page 55 to 68. Many of you will have heard in the press what happened at Mansion House, and I will say now it is very, very early days, and there is going to be a consultation at the end of January. So let's not distress ourselves before we know actually the facts. But it's not quite as drastic as we had first thought. So, Kat Turi, responsible investment analyst, is introducing the report with Bullish, senior financial analyst, investment supporting it. So, Kat, tell us the news.
Thanks, Chair. So, as you reference, I'm sure many members will have seen in the news the Mansion House proposals. So on the 14th of November, the Chancellor announced the new LGPS consultation called the Fit for the Future consultation. This report was written with a week of consideration, so I think a lot of what's in here is kind of an early view on this, but I think it is quite important to start to understand what these might mean for committee, because even though I think the proposals aren't going to materially change, we will have to look to see where we can kind of influence, so any kind of implementation of the proposals are kind of in a way which fits with the funds fiduciary duty. Given the timescales, we're asking for the committee's views, but then also for approval to delegate it to the Director of Corporate Resources in consultation with the Chairman ahead of the 16th of January deadline. So, as I said, pretty much it's kind of just continuation of the proposals which kind of started in 2015, the start of pooling. And I've split this into kind of the 3 main areas, so LGPS pooling, local investment and governance, and I'll take you through the proposals and then we'll kind of go over kind of key fund considerations at this time. So some of the kind of significant changes and how it will change the fund's current, what it's proposing to change how the fund currently interacts with the pool, will be the requirement on administering authorities to fully delegate the implementation of the investment strategy to the pool. So in January, if you think you normally have the strategic asset allocation, this would mean you would kind of consider the return objectives, risk tolerances, constraints and limitations, and a high level approach to local investment and responsible investment, but they would be limited to the more broad strategic level and limited to kind of broad asset classes and general investment themes. It would then be for LGPS Central to implement the approach, and that would include how they adjust the asset mix, geographic allocation, and appointments of managers and choice of investment opportunities. So I think if you think in the context of the committee and the investment subcommittee, this would kind of have some implications with how they act. The second key proposal is for administering authorities to take principal investment advice from the pools. So at the moment, Hymans Robertson is the fund's investment advisor. In the current process, the fund engages with Central in the pipeline of the development of these kind of SAA recommendations, but this would change. So pools are principally advising on those proposals. Third, and probably kind of a more significant change than what we've heard from previous governments, is that administering authorities will need to transfer legacy assets to the management of the pool by March 2026. I think, as the chair said, it's hard to kind of second guess what might happen here, because there's plenty of different ways that assets can be transitioned, and the next paper on summary valuation talks more about what legacy assets we do have. But if, in the case where management of these liquid assets are transferred to central, they would have that kind of responsibility on whether to hold the assets to maturity, whether to roll them over or invest them elsewhere. And I'll move on to local investment. So again, this is kind of a change from kind of previous governments, how they've kind of set out local investment and what was previously known as levelling up. So they want funds to set out an approach to local investment with regard to local growth plans, and then also local economic priorities in how we set the fund's investment strategy. And it wants funds to work, funds and pools to work with local authorities. The definition within the consultation sets local investment as the pool area. So for central, that's quite a neat area in that it's kind of all connected. So I think Nottinghamshire, Derbyshire, West Midlands, I'm going to miss Shropshire, Worcestershire, West Midlands. Well, I'm sure I've missed Derbyshire. Yeah, I'm sure I missed some, but so it would include setting a target for that. I think in the report it said we weren't sure if the fund would need to set a Leicestershire and Rutland type target, but it does seem more broadly it'll be across the pool area. And since the consultations come out, the government has also been talking more about sector-based investments. So kind of housing across the UK counting as local investment, and renewable energy and kind of bigger sector areas which government think will kind of move the needle on growth ambitions. The third kind of key area is on the governance and the governance of funds and pools. So a lot of these are kind of changes and recommendations which came from the Scheme Advisory Board's Good Governance Report, so nothing particularly new or surprising. Some of the kind of changes relate to funds participating in a biennial independent governance review, so similar to what the local government association do with their peers challenge services. And then there's also a requirement for pension committee to include an independent person who is a pension professional, whether as a voting member or an advisor on this committee. These are kind of proposals, probably, but pool boards to include 1 or 2 representation of shareholders. I think they think this will help maintain the kind of views of partner funds on pool boards, and also kind of a proposal for funds to appoint a senior LGPS officer. But I think in practice that would be the Director of Corporate Resources for this fund. So for the kind of initial considerations of how the fund can consider these, I think, as I said, it's unlikely that these proposals are going to change significantly. It's kind of just continuing on what started in 2015. The fund has seen plenty of benefits from pooling, so I think it's positive in that, in terms of it gives that kind of long-term view of what funds need to aim for and achieve together. But I think it always needs to come back to that primary purpose about how these changes are enacted by the government, so we don't lose sight of the fund's primary purpose. So I think some of the kind of main areas that the fund will want to try and influence through any consultation response relates to the fiduciary duty. So with some of those first proposals, it potentially could cause administering authorities limitations in how it holds pools accountable, because ultimately the funds will invest in pools no matter what. And there's some difficulty with administering authorities and how they kind of behave within the structure of the pools and how they can kind of hold those accountable as it currently stands. So we'll have to ask government to make sure they consider mechanisms that promote this effective pooling, but also ensure that risk taking remains within acceptable bounds to not ultimately cause any higher burden on employers within the scheme. So there's areas this can be supported. So pools having the fiduciary duty extended to them, and then kind of having to have appropriate checks and balances between the pools and the partner funds with how any implementation of investment strategies are applied. Second one, conflicts of interest. So again, back to kind of that implementation point. If pools are primarily advising on setting and implementing the strategic asset allocation, there's potential conflicts there. So it's kind of like marking your own homework in a way. Do recognise there probably are ways that you can improve the current system. So obviously every partner fund has their own investment advisor, probably not the greatest in terms of supporting pooling if you're getting different advice from different advisors. So, but we think there's ways you can kind of get around that without pools necessarily advising on every part. And yeah, we could have it where pools potentially partner funds procure their own investment advisor as a group. And that would retain that kind of independence and knowledge within and maintain the fiduciary duty. For the capacity, so the proposals represent a significant increase to requirements that are currently with pools. So if that March 2026 deadline is to be kind of stuck to, that 16 months where pools will have to have a massive transfer of legacy illiquid holdings, and then also build out these new capabilities in investment advice and local investment. For the fund, the committee and investments committee have made plenty of commitments to Central over the years, and there are still kind of plenty of capital left to deploy. So considerations will need to be given to how funds can deploy this capital, and whether that is letting pools invest in external managers and not just waiting for kind of appropriate mandates to be developed in-house might be a way for the funds to help with that process. And there's also careful considerations to be how best these liquid assets are managed, whether it is appropriate for pools to build out the resource required, or whether there are assets which are better to be managed in-house by partner funds' existing resource, and then kind of manage those down over time. For local investment, it's clear the consultation doesn't mandate local investment at this point, but the Pension Minister has stated that if these reforms do not produce a significant increase in the share of assets committed to domestic investment, then the government could start to compel British funds to invest a certain portion of their money in the UK. So I think it's clear, even if that this kind of is something that is going to happen at some point in time, if sufficient progress is not achieved. And I know committee has had many discussions about local investment and some of the kind of challenges it may be. So, the concerns around diversification, availability of opportunities, and potential political risks if not managed carefully. The fund, potentially proposals would instead suggest a broader UK-wide definition, which kind of builds into some of the later kind of views in terms of those sectoral based, which wouldn't limit the fund and the pool in terms of specific areas. Also, I think it's pooling probably helps get rid of some of those conflicts away from committee. But of course, any investment has to ensure that returns are no less than they would otherwise have targeted, and again supported through the pools having the same fiduciary duty as administering authorities. I think for the governance issue, I think while it's something I think we've welcomed for a number of years, improved governance recommendations, and the committee has taken on board even ahead of these proposals, I think there is kind of concerns that considering the proposals look to take away from certain areas in terms of investment strategy overview and areas like that. We're also kind of increasing those governance responsibilities at the same time. So kind of have to make sure any ultimate proposals are proportionate in the requirements on partner funds. And just to say, I suppose, unlike what was in the media, I think the day before the proposal actually came out, there's not actually proposals for a mega fund or kind of combining partner funds. I think there's a real drive to see where the collaboration can be achieved through pools. I think that's something that is easily welcomed. But I'll leave it there for the views of comment from committee.
Thanks very much for a comprehensive introduction there, Kat. I mean, I think we've discussed this in quite a lot of detail before. Am I right in thinking that there is prime legislation needed through Parliament on the pensions bill? Or what sort of time would that take?
So, from everything that's been said, obviously, there's nothing set in stone. They want to get the consultation response ahead fairly quickly after we respond, and then they want to, I think, formalise something by the end of end of next year, and then kind of ultimately implement it. But I think I think it's clearly the trajectory. So I don't think whatever comes out of the consultation, it won't necessarily be worth waiting for the primary legislation to come in to kind of be forced down it. I think better probably to.
Yeah. So you think they'll implement it before the legislation has been passed?
Yeah, or they'll
we'll
have to see what.
Yeah, we'll move it towards. I mean, you're right. I mean, there's 30 questions within the paper. They've been answered. I know what all the concerns are, and I think they're going to be the same for everyone. Are we still going to be able to get the same levels of returns under directional control than if we didn't? And will it still be government, and will we get advice? Well, in honesty, our job as a pension committee is to make sure we can pay the pensions. We've talked in a previous item about the certainties and uncertainties. This is certainly, as you will see in the risk register that's coming forward in this paper, this is probably a big risk. Can we change it? Can we kick against the government of what they want to do? Well, if they pass it through Parliament, we can, we have to comply with their legislation. The risks are obvious. I really don't want to prolong the debate because it's still uncertain. I don't want to start hairs running and getting excited about it when it isn't actually in force for the moment. And we have discussed in great detail the risks and also the fact that if they start directing us, that we would want them to take over, underwrite it. So let's not run over those. But if any other questions? Any other, Phil?
Yeah, thanks, Chairman. So look, there are probably elements of what the government's proposing that might be positive, but equally, there, as you rightly say, there are some elements of it which alarm bells are ringing very loudly. And I'm just wondering, we've sent a response in from Leicestershire. Is it that the county council, or is that the pension fund who sent a response?
Well, we can make comments which could be included. We could, if you want to include something in it. Am I right in saying it can be included?
Sorry, I just want to check the appendix. If you're talking about the appendix.
Yeah, the 30 questions.
The appendix was response to an earlier call for evidence thing. So so we've not written
that was
response
a
yet.
response to an officer question and answer session. Yeah, I've read that. So, but what I was going to say is this. Okay, so we're sending a response in as Leicestershire pensions. I'm just wondering if actually there might be some strength in the members of the pool sending a response, and the pool actually all members across the because obviously there is a local. I can't remember now. There's a standing advisory. Is it a standing advisory committee?
Standing advisory board.
Yeah. Which is the am I right? That's the local government. That's the local government.
Talking about SAB, Strategic Advisory Board. Yeah.
So I'm just wondering what other other pension funds across the are all, because obviously everyone's got a slightly different view on it. But are there some common strands that, you know, as a sector, we're putting back to government to say, you know, maybe yes, no, or whatever words we're using, but essentially that's what it comes down to. And it's not just Leicestershire saying that. There's actually a coordinated approach to this, because I've just got a fear that if we're not waving our, you know, putting ourselves forward in a very positive way, the government will just do to us, and you know, whatever happens will happen, and you know, and at the end of the day, that could be adverse to our pensioners, potential future pensioners, and to, because essentially that's what this is about, and that is concerning. So I think that's what I'm just wondering is how we're working together with the other funds in our pool, but then across the wider sector in England. Thank you.
Okay, so I'm going to ask Bulesh to answer this. I know that he's in touch with the other pension funds within the pool on a regular basis, but apart from that, Bulesh, have you got comments?
Thank you, Chair. So yes, we speak to the other funds within our pool, so the other 7 partners. In the past, it's quite difficult to find good common ground across all subjects. Now we've got a really wide consultation here with 30 or so questions, so there's very little chance we'll have common ground across the lot. And of the main subjects, we still may have differences, so it might be hard to put across a joint response from us all. But if we can find a way to find a few common areas, then I think it's a good idea. Whether or not the others want to do that might prove to be the difficult point.
Declan.
Just, I suppose, building a bit more bluntly on that, the problem Central's got is it's one of the lowest pooling levels in the kind of the country, and that is because there's a mixed approach across the funds. So ourselves are one of the sort of the funds that embrace pooling more. So this is less of a shock to the system, but truth, some authorities are really resistant to this. But I think where you touched it in the middle of it, Phil, about kind of, well, if this is the government's direction, don't kick out against something that you can't kick. You know, you're never going to win. And I think that's absolutely right. That when we've got a kind of and that's what I suppose what we're covering is just a steer from the committee to make sure we're sort of on the right lines. And I suppose that the sentiment that kind of Kat laid out, is try and summarise that, is very much kind of, look, pooling's inevitable. We're going to have to sort of pool the asset. They're going to be the people who are going to invest in it. But actually, there are certain elements of how we're going about it that could be tweaked. So I think we can embrace where government is saying you need to get to, you know, sort of economies of scale, you know, really putting managers under cosh to give sort of better value fees rather than trying to sort of do it individually. But we just need to make sure we've got that balance right between the responsibilities that this committee is still going to hold, but the ceding of that power to kind of Central. So I think, so from what people have been saying, I think we can find that balance still about kind of, you know, overall being positive, but actually with some sort of caveats in there that it should be fair game for the government to sort of have a bit of a look at it. But I do think it, to Bulesh's point, it's going to be very hard to get consensus across everybody just because people's mindsets are in very, very different places.
Yeah, thank you. So, David, did you want to have section? And Nick? Yeah.
Yes, thank you, Chairman. Yes, I'm fully supportive of the committee's approach to this and what's been said this morning. That all makes sense. But just on a personal note, and I had a word with you, Tom, about this. I've got a suspicion, really, that with the government hell bent on growth at all costs, whatever the cost in human terms, this is all part of an almost sort of desperate way to raise funds. I just have this natural distrust of government of all shades to have influence in the way money is invested. I've just got that. I have a trust in our managers, but I'm not so sure I have trust in politicians swing around from one idea to another. One day, investing billions in HS2 was the be all and end all. Next day, on a whim, it no longer is the policy. There seems to be a sort of
well, I find it hard to trust politicians who come up with grand ideas to solve problems which are very, very difficult to face up to. I mean, we got the right approach, but I've just got that sort of deep-rooted suspicion of people who come up with grand ideas which just crumble away to dust at the end of the day.
I think one of the things is we are in a better position than many of the funds. I do understand what you're saying, and I think one of the concerns that will be raised in response to the consultation was they're suggesting that they're going to ask to concentrate on areas like housing and green energy. We will see what our fund managers can do in those areas and what sort of returns they can get in comparison to others. But to be frank, at the end of the day, our comments and will encompass that. And if there is legislation, we will have to comply with it. And I think the idea that we're going to pool all the assets, well, it's going to happen. But I do share your concerns, very much so. But let's not prejudge it. Let's see what happens. Declan.
We can easily add a piece in there, and we were going to build out what we were going to do about, it's important that the investment returns are commensurate with what you could get elsewhere, and we can strengthen that for it's got to be, I suppose, analytical, kind of investment manager led rather than political led. So we can certainly strengthen that part of the response.
Thank you, Declan. I think that's very true. I think rather than politically led, it's got to be actually common sense for our usury returns and, doing our duty. But it is early days, very early days. Nick.
Thank you, Chairman. I reiterate and support the previous comments that's been going on, particularly about the distrust of government of whatever political colour, and in terms of directing investments. It's not their money, it's our money. And I would not want a government promise. I'd rather have real assets behind it. Specific questions, legacy assets. What about things that property we own, farms and things like that? Are we subject to, we then get collared by SDLT? And the other thing is, we invest in pools no matter what. Now, yes, we're going down the pooling route, but what happens if the pool comes up with a suggestion and we think, no, we must have a position to say, no, we don't agree with this. This is not in our interests. Now, you need a break position to say, otherwise it's their money, not ours. We would need that fallback. Hopefully we never have to use it, but we would need that fallback.
We're not abdicating responsibility completely to the pool. We do still maintain some responsibility. Declan.
And that is one of the worries that we've got the responsibility, but we've got less control. So it is a difficult one, because in fairness to government, if they allow us to pick and choose the pool, the whole thing becomes some sort of, I don't know, sort of dysfunctional kind of mess. But it is one of the areas we will feed back on about kind of, that it's got to be a two-way thing. It can't be a linear, we set a strategy, they run off and implement it. Ideally, they come back and say, actually, this is the implications of the strategy you've set, and then there can be a bit of a sort of a refining. So I think we will respond to something on that lines, because you're right, you just don't want kind of people to run off, but ultimately there will be a sort of ceding back of that control. I don't think that's an area we can fully get away with. In terms of the property piece, Willis may be able to come in, but people are conscious of that kind of sort of the transfer and all the costs of transition. I don't know whether, has it been agreed with HMRC that work around?
There are ways to be able to pool direct property, for example, without having to sell and rebuy. So you can stick them under arrangements such as you don't have to sell it and we keep. So we're working on something at the minute for our own direct property portfolio so that we can pool that with Central.
The other query I've got in terms of if they rely on primary legislation, they haven't actually, then it has to go through the detail in Parliament and then it gets scrutinised. So it might be an idea to wait on for some of this primary legislation within that, rather than just agree to everything in advance to see, because at least in Parliament, even though government's got a big majority and presumably it would go through, but there would be some detail behind that, and the fear that the Treasury would have is actually having to underwrite it, the LGPS, in explicitly in terms of the national accounts. And that would be the fear that they would have. And therefore, would that mean that the primary legislation would not be quite as restrictive as what the government might like?
I think it's one of those, well, I suppose we'll wait and see what the response to the consultation comes out. I suppose Pat's point was very much, we're making long-term decisions. The last thing you want to do is make decisions heading left, and then actually you have to sort of unwind that, which is expensive. But no, it's a fair point. I suppose the only thing I'd add is this does have cross-party support. So I think Jeremy Hunt's come out and sort of said actually it's broadly where they were wanting to go anyway. So it does feel it's probably going to get through fairly unscathed. But it's a fair point. You shouldn't assume what things are going to be. But I think we've just got to bear in mind if we're making any investing decisions, we've got to move. We're pretty close to the pool anyway. It's not as if we've been going off on crazy directions, but we've just got to be a bit more hand in glove with the pool.
Okay, thanks very much.
Very quick one. Agree with the concerns that have been put out there. I agree with what Declan said he'd be putting in. I mean, I think the direction of travel is onto more pools and putting money into government investment sectors, that sort of thing, which I accept that in a way we're going to have to move towards that. I think with the pooling, yes, we are putting more in pooling in principle. It's a good thing, but like as I've already said, non-pool investments are good. The government investment side does give me concern. I think in the consultation we need to just make sure that with these investments there are the checks and balances on what they are putting forward. My experience of government projects, both working on them and seeing an overview of what goes on, they tend to go out of control on the budget, and that becomes a investment problem. The private sector is probably better suited to these things because they tend to work within a budget. A lot of the things to get the project forward, shall we say, is I suppose sort of it's just not correct. It's sort of done to get the project forward, and once the government or local authorities agree to a project, then an extra million here, extra million there, sort of becomes okay. We're down that route, and things like that should have been looked at in the first place. I think, yeah, my concern is the checks and balances, and if we are investing into some of these government schemes that do produce the right return, then fine. That's good. But I'm very, very sceptical about the HS2 as a prime example. Just looking how that has spiraled out of control. Thank you.
Thanks, committee. I mean, I can't say that I disagree with anything anybody said. We really do not want to be in a worse position because of this than we would have been had we not gone. Actually, ironically enough, I think Bhulesh will confirm it, but we already have about 21% of our assets invested in the UK. Is that right?
Sorry, I think at the last annual report we said just over 20 or so.
Is it? Yeah. It's just over. So we're getting there. So we probably haven't got as much of a challenge as some, but very much take on board what you're saying. We've discussed it before. I share your concerns. I think what Declan said is the government of any, this is a non-political committee, but whatever government was in power, they would probably have gone down this route. But yes, I absolutely understand, and we will get it in the consultation, that we don't want to be used as a piggy bank, as a quasi piggy bank for the government to achieve political objectives on the basis that it's going to be detrimental to our pensioners. And I think I'd put it as succinctly as that. Now, what we can do about it remains to be seen, but let's see what happens in the consultation and the response. And very much take on board your comments this morning. So, has anybody got any other questions? Roy?
Here's the brief one. Given it seems to be inevitable where we're going to end up, I think we should be moving quicker to move in that direction now because the better opportunities will be out there when other people are waiting to see.
Yeah.
So I think we should just run with it,
Yeah.
because I don't think there's any chance it won't go the direction we expect.
I'm sure you're right. I think, in other words, get in before the rest do, and the market becomes less stable. Well, that's certainly something we can consider, but I think ultimately we need to respond, as we've said. It's a good point, Roy. It's a good point. Look, has anybody got anything else they want to say there? No? So the committee has been asked to note the government consultation titled Local Government Pension Scheme Fit for Future and comment on the main themes, which we have done. And the committee has been asked to authorise the Director of Corporate Resources, following consultation with the Chairman of the Local Pension Committee, to prepare the detailed response to the consultation on behalf of the fund, taking account of any comments that have been made this morning by the committee, and submit this to the government by the deadline of the 16th of January 2025. Can I have a seconder? All those in favour? Right, that's unanimous. Thank you very much, and a good discussion there, and very valid. The next item on the agenda is the summary evaluation of the pension fund, and reported at page 69 to 86 for the agenda. Ulas, you're introducing this report.
Thank you, Chair. So this is our standard quarterly report, and the purpose is to provide an update on the investment markets and how asset classes are performing. The report also provides an update taken by the investment subcommittee at its meeting in October 24 with respect to an investment recommendation in sub-investment grade debt, and also seeks approval for a proposal to commit £25 million to a timberland investment. Points 3 to 9 cover general market performance. So that's for the second quarter, June to September. We've got global equity markets rose during that quarter. The key drivers were easing inflation in the US, a 0.5% rate cut by the US Fed, and continued optimism over advancements in artificial intelligence. You see a graph there at point 4 showing the top line there is the MSCI all country total return. So that's at an all-time high. You can see how it's risen pretty much over the last year quite considerably. US inflation did ease over the quarter to 2.5% in August, down from 3% in June. The euro area inflation also fell to 2.2% in August, and UK inflation measured as CPI was flat at 2.2% in August. Asia Pacific, going on to geographical areas, Asia Pacific, excluding Japan, was the best performing region. China's stock markets had previously fallen quite a lot, but soared on government announcements of a raft of stimulus measures. Japan was the worst performer, and that was hit by a unexpected interest rate rise by the Bank of Japan in July. We do have exposure to all of those areas. We do it via passives and also via an active product from LGPS Central and from LGIM. Recent inflation developments, you can see at point 7, you've got a graph there, leaves scope for central banks to lower interest rates. Most major economies are pretty much near 2%, which is the part of that graph there before the grey area. Core inflation remains higher than 2% in the UK, the Euro region and the US, however, but is forecast to stay around that level going into 2025. Risks exist to higher inflation from wage growth, which is still elevated across major advanced economies, and business surveys point to an acceleration in input cost inflation in the service sector. Moving to asset classes, UK property, some glimmers of hope have returned. Annual returns have risen with income offsetting the capital declines. Over the last 12 months, the total return of the MSCI UK Property Total Return Index was a positive 1.9%. Capital values still fell, offset by income. A survey by RICS, which is the Royal Institute of Chartered Surveyors, suggests rent will continue to rise alongside improved occupier demand and increasing capital values. If you go over to page 71 at the top, you can kind of see the profile of how capital values have changed. If you look pretty much halfway through that table there, you'll get to about February 2022, which it looks like the peak, but that's the point where interest rates were at 0.25%, and that was the first raise from 0.25 to 0.5. And if you see the real bottom there where capital values year on year were declining the most, that's August 23. That's the point we reached 5.25%. So you can see the impact of the interest rate rises on the property market. We think we're probably past the worst, but you can never really tell. So moving on to point 9, our normal table there showing asset class performance over a variety of timeframes: 3 months, 1 year, 3 years, 5 years, 10 years, and 20 years. Pretty much the same story we've had over the past year or so. You'll note the global equities. I think we talked about it earlier, and how we might not have the same that we've had previously. The last 20 years have been 8.8%, and I think that's pretty much all I want to say for that area. Any questions before I move on to our portfolio in general?
Just a quick one. When you were talking about Asia Pacific, you mentioned China. Do you know what level of investment we've got in the Chinese economy itself, given its situation?
I couldn't tell you at this point, but given that we have just a number of mandates, we only have LGIM Investments and LGPS Central Investments, we could probably get to the answer fairly quickly. We'll probably have a fairly low, we've got a lower exposure than we used to have. We've removed some mandates over time, so we've probably trimmed it a little, but it's probably about market average, but I can certainly get back to you on that.
History, really. There was a time when this county council really tried to build links with China. We put tremendous amount of effort into it. We had civic visits in both directions. We had Chinese investors in here, and there were it all and in fact, if you look in the chamber, you'll see all the trophies that were brought back and friendship agreements and everything. It's all changed now. Now we have to withdraw, and it's just it's just a time when there was hope that there was going to be cooperative working between ourselves and that part of China that we took a great interest in. And then it all, like life has changed, everything changed, and now we have to withdraw. But it's great. I think it's a great shame, really, that we lost all those contacts. But and it was only just a few years ago.
Yeah, no, I remember it. It is unfortunate because building links would have been good, but unfortunately politics has got in the way of it, and it has on both sides, to be frank. It's not just all one-sided, and that has put the blocks on it, which is again very regrettable, but there isn't anything we can do about that. We are where we are, but I don't disagree. It would have been nice if we could have a much more sort of the geopolitics of it has just gone crazy over the last 5 years. Roy?
Yeah, just to come back slightly on that, the political situation is very difficult, obviously, but economically, China's teetering on the brink. Their MABs are artificially protected by government measures, but even the Chinese haven't got a bottomless pit, so it worries me greatly.
I agree. They haven't. In fact, they're in deep trouble, and it is only the government that is propping them up. But we'll take it from there. So, bullish.
Okay. Moving on to portfolio changes that occurred for the quarter ended September 2024. So this isn't everything, but these are the main ones. So we've got 4 in total here. We've added £70 million to the Central Global Active Equity Fund, and that's just to rebalance to the 12% of total fund assets, which is our SAA target. We removed the Central Emerging Market Equity Fund in total. We divested twice, totaling 190 in total. Again, that's in line with our SAA target. Ruffer, one of the 2 managers we have within our targeted return pot, we added £20 million, and that's to rebalance to 3% of total fund assets in line with the SAA target. And then finally, the Central Direct Property Fund called £18 million for a property they bought. That's part of the £120 million commitment we've got to that fund with LGPS Central. About half of it in total has been drawn so far. The net effect on cash quarter on quarter has been an increase from 417 to 456. Over the quarter, money has been returned from closed-ended funds. We've got net income from being cash flow positive, and that's part of the reason that we've got a slight increase. 13 to 19 talks about our cash holdings and our outstanding commitments. So the cash held by the fund is higher than the strategic asset allocation limit of 0.75% of total fund assets. This, alongside a cash flow, is presented to the investment subcommittee each quarter. At the quarter end, the fund held 456, like I've said earlier, and in addition, £90 million is also held with Aegon in collateral for the currency hedge that we employ with them. Taken together, this is 8.4% of total fund assets. Going back to that 90 million, at the end of September, the USD rate was well above 130. It's fallen significantly since, so that 90 million will have been reduced as a result, but the pounds value of our dollar investments will have gone up conversely. That additional cash is as a result of the SAA recommendations in 2022 and 2023, which prompted a switch from our liquid assets, mainly listed equity and targeted return, into illiquid assets, largely which reside within the income asset group. These illiquid assets take time for investments to be called by the underlying managers. The reduction in liquid assets has continued. The fund, however, is still overweight to listed equity, and whilst we're overweight in cash, we've decided to keep this overweight in listed equity rather than add even more cash. The fund has made relevant commitments in order to add to its illiquid asset classes, and most of these are in the process of being called. So at the time of writing this, over £940 million is awaiting to be called. 750 million of that was to LGPS Central products. In addition, the fund also has approval to commit a further 260 million to LGPS Central products in 25 and 26 across infrastructure asset classes. Moving to page 73, point 19. A cash flow forecast estimates that funds should gradually reduce over this financial year ending 31st of March 25 towards 375 million. However, it is dependent on a number of factors. There's three listed there. The speed at which the significant commitments we've made are called, the pace at which we decide to reduce our listed equity overweight to that target 37.5% of total assets, and the pace at which investments into the LGPS Central Multi-Asset Credit Fund are made. That last point C, is covered on points 20 to 25. I noted this at the last committee in September. The position hasn't changed much. We paused our investments into the LGPS Central Multi-Asset Credit Fund. The target weight to this product is 9%, and at the current snapshot, we're about 6.5%. We paused it. There was an investigation into one of the managers, Western Asset Management, which is one of the two managers that we use there with Central for the Multi-Asset Credit Fund. And whilst that investigation is ongoing, we decided to pause these investments. LGPS Central are investigating options for the product. It may consider a manager switch, but until this is decided, we've thought it was prudent to pause that investment. Over on page 74, we've got a table which explains, or at least highlights, where we are overweight and underweight. So that first table there, where you can see the asset groups, growth, income and protection. I'm just going to count across columns, 1, 2, 3, 4. The fifth column across, the difference, which is the difference between the actual position and the 2024 SAA, you can see that the income asset group with a minus 10.4% is where we're underweight. And that's where the bulk of those, the 900 million I talked about, which is yet to be called, is residing. Most of that will be fed from the cash position that we have and that slight overweight that we have within listed equity. Table below it is the subsection, so you can see the asset classes, and you can also see there within that income group, the middle block there, where we're relatively underweight on all of those: infrastructure, private credit, property, and the one that's labelled global credit liquid. That's that MAC fund that we just talked about. Moving on to the overall investment performance, we've amended 3 more benchmarks in this quarter, which completes the changes that we'd planned for this year. So you've got a table there showing the 3 benchmarks that we've changed. 2 are CRC funds and one's the LGPS Central Real Assets Fund. Effectively, we've moved from benchmarks. So the first one, for example, a 7.5% target for the CRC CRF3 fund to a 9% target. Now, these targets have been changed in order to better compare the investment risks that we're taking for those products. So it does make our comparisons to our benchmarks harder, but it more accurately reflects the risk that we're taking. We've got our standard table at 29, which shows an overall performance for the fund as at the 30th of September. Looking at the 3 and the 5 year totals, we're positive across all time frames, but over 3 and 5, 3-year return is 5% per annum and the 5-year return 6.3% per annum. Those comparisons to benchmark, you'll note, are slightly negative now, and that reflects a year's worth of changes that where we've been adjusting the benchmarks. Happy to take questions there before I move on to pooling progress.
Yeah. Anybody got any questions? Phil?
Yeah, thanks, Chair. Thanks, Bilash. If I can just go back to I've got a query about the LGPS Central Multi-Asset Credit Fund update. In this, you revealed that one of the managers is under investigation by the Securities Exchange in the US. And I know you're saying that it doesn't have any effect, but obviously there is going to be an effect on this fund. If people take their money out, it's going to depress the value, I assume. Are our managers expecting it to, if I can put it like this, bounce back eventually? And what's our actual exposure? Because I couldn't actually see that very clearly here.
Okay. I'll take the last bit first. We're £400 million invested into this fund. It's a fairly large fund. It invests in very liquid credit. So, you know, although there might be people who take the money out of Western Asset Management, the underlying investments that the manager makes are highly liquid. And you know, in terms of their pricing, they'll be dictated by general market forces rather than one manager.
Okay, that's great. So we're keeping an eye on it then.
Yeah.
Okay, right. Second point I wanted to make, Chair, is obviously this was written at a certain time and the Chancellor's had a budget, which I'm trying not to be partisan, Chair, but lots of business commentators have said it isn't very good for business investment in the UK. And what I'm concerned about is, what do we think, or is it too early to say what the likely impact is going to be on UK investment sentiment, but also on growth? Because we've already got, you know, announcements of major plants closing like Vauxhall, things like that, and that's obviously going to have an effect at some point on the wider economy. So I'm just wondering, I'm assuming that hasn't been taken account of in this report, and we're waiting to see how that pans out later. Would I be right in that?
Yes, you know, this report was written as at the 30th of September, so
right,
all the financials in here reflect that. But just to come back to your earlier point about UK growth in general, we don't have a huge exposure into, you know, listed equity within the UK. We've been becoming a more global fund over time. Most of our listed equity exposure is global in nature now, so we've got limited exposure in that respect.
Well, that line links, as a segue, Chair, back to the consultation response to the government's proposed changes and what impact it's going to have on our future returns for the beneficiaries of these investments, which is the pensioners, you know, existing ones and future ones, of all the scheme members. So that's the concern I have is, you know, what on the one hand, government talking, you know, we want you to invest more in UK PLC. And on the other hand, conditions in UK PLC are, let's put it like this, choppy. I think that's what I describe it as, and therefore not necessarily a very good investment opportunity. That's my take on it at the moment, but obviously we'll have to wait and see. Thank you, Chair.
Just to come back on that, I think you're right. You know, all the due diligence that would need to take place to invest into what the Minister described as de-risked UK projects would have to be good due diligence, and Central, if they were making these decisions on the partners' behalfs, would obviously have to undertake that and demonstrate through governance that they'd taken the appropriate steps. Partner funds would obviously want to have a view into how that was progressing, and you know, we'd want to be very careful about the first few steps, no doubt.
Thank you very much.
I was just happy to continue.
On from what Phil said, I've got a very old-fashioned view, I'm afraid. I've been here too long, I realise that. But when I started working here, I came here a few days, or 1 day a week, whatever it was. The rest of the day I was in industry, manufacturing. And we sold products to the whole world. People could move from factory to factory because we actually were selling things. There used to be a slogan just after the war, people won't remember it, export or die. Now we've forgotten that. If we're not making things and selling things to the world and just buying things in from China and stacking them in Magna Park, we're never going to get anywhere in this country. And I listened to the budget very carefully, and I heard it was, you know, the good lady say she's going to take all the money from the pensions and spend it on housing and the rest of it. But that isn't growth. You're not going to get growth until you actually get more income than an expenditure. And you're only going to get that if you're actually bringing goods from the world, like we always used to, process them and sell them off to the world again. And this is what made this country wealthy and has enabled us to do what we've able to do, but we've just stopped doing it. Until we actually get back to manufacturing and doing what we were always good at, we're just floundering around, playing around with past assets, and we're just not going to get anywhere. I can say, you know, Magna Park is a really good example, really, of where we're not. It's not full of goods that we've made in this country and we're going to sell off. It's just full of goods which we're importing and filling our roads with HGVs full of foreign goods and selling them off through Amazon. There's no future in that. I mean, unless I've misunderstood it and I understood the situation as a whole, I just can't see where we're going as a country. I really can't. Sorry, Chairman. It's just I just thought I'd get my personal view on.
That's fine.
Yeah.
Thank you, David. Roy.
Yeah, to expand on what we were saying before, given the weighting we've got to overseas investments, I just wonder, when you find out the figures for China, could you include the rest of the BRICS countries so we've got a political take on where we are investing our money? Bearing in mind that the likes of South Africa, etc., are considered now part of that grouping.
Yeah, we could do that. Okay.
We'll do that. Yeah.
Happy to continue. Okay. 36 to 40 covers off our pooling progress. In light of the recent Mansion House speech and subsequent consultation, we've got a table which probably best describes where we are. Top of page 77. We've split it into a number of columns here. You can see a pooled column, a plan to pool within less than a year, liquid investments and illiquid investments. So our first column is everything that we have with LGPS Central. It amounts to about 40% of our total fund. What we've got in the second column there is what we plan to pool within a year. Now, really, we've only got two bits in there, which is 1.1 billion, which is all our LGIM assets, and that small 93 in property is our direct property. That's another 18%. Added together, we're about 58% pooled. We've also got is that third column, which is liquid investments. These are things that could be sold or are semi-liquid. Add those in, and we're about 27, another 27. So that takes us to about 86%, which leaves us that final 14%, which are hard to sell. And if you wanted to sell those, you might have to do it at a discount and take a loss, depending on what the supply and demand is for those things. So what I'm trying to say here is that we're in a fairly good position in the sense that from a pooling perspective, it's not that difficult for us to get to a really big number. So that just adds to the bits that Kat was talking about earlier, and it should kind of allay some fears on, you know, how well or how fast we could get fairly well pooled. Any questions at that point before I move on to 41?
Any other questions?
No, okay.
No, carry on.
41 just talks about the investment subcommittee approval at the 2nd of October. Subcommittee were asked to consider a proposal to invest in a bank risk share investment. The advisor, that's Hymans, had considered a number of ways to maintain exposure to this asset class and recommended to the committee a 40 million commitment to the existing manager's Capital Relief Fund 6, pending satisfactory legal due diligence. Hymans, the fund advisor, and CRC presented on the day and took questions from the ISC. The last part that I want to address, which is an additional commitment to the Stafford Infrastructure Timberland Continuation Fund. The ISC at its meeting in July approved Stafford Capital Partners' proposal to create a continuation fund, and that will be formed from investments within its 3 closed-ended funds. So that would be SIT 6, 7, and 8. SIT being Stafford Infrastructure Timberland Funds. Now, the benefit of continuation funds such as this is that the assets which these closed-ended funds hold are rolled into the continuation vehicle, which avoids capital being sent back to us, which we then have to redeploy again. So it's an easy way to maintain an allocation. To maintain our allocation to Timberland within the overall infrastructure holdings, we've got a 20% allocation within our 12.5% allocation for infrastructure. Multiply them together, it's about 2.5% of total fund assets, which is our target allocation to Timberland. It's a relatively small allocation. Hymans looked into various ways to you know, keep this allocation to 2.5%, and looking at the various options available, they settled on an additional investment into this continuation vehicle. I think that's pretty much all I'd need to say. I think we're on to recommendations.
Okay. Any further questions? No. Right. So the committee has been asked to note the update provided regarding investment markets, how individual asset classes are performing, and action by the investment subcommittee at its meeting on the 2nd of October 2024. And overall, the investments are performing, which is good. And also, the committee has been asked to approve the recommended 25 million commitment to the Stafford Infrastructure Continuation Fund. I'm happy to move the recommendation. Can I have a seconder? Thank you. All those in favour? That's unanimous. Thank you. So we now move on to agenda item 9, is the Investment Advisor Objectives 2025, which we've set for our investment advisors, Hymans Robertson, at pages 87 to 100 of the report, and they're fairly comprehensive. Bhulesh, over to you to introduce this report.
I'll be relatively quick here. So the purpose is to provide committee details regarding the 2025 proposed objectives for our investment advisor, Hymans Robertson. The investment consultancy and fiduciary management market investigation order in 2019 requires pension scheme trustees to set strategic objectives for their investment consultants. The fund has set these and agreed these with Hymans Robertson over the last few years and submitted these to the CMA, that's the Competition and Markets Authority, during the first week in January each year. I'll just point out at point 5 here that the changes that we've added. So we've got inclusion of the fund's net zero climate strategy, and it's not a whole change, it's just strengthening the area. So it's been in there in previous years, and its approach to responsible investment, and it's reflected within the decision making and governance for the fund. And 5.2 there, in light of the recent direction of pooling and the Mansion House proposals, the advisory objectives will include consideration of pooling in general on a wider scale in respect of investment proposals which are currently held by the fund. So,
Okay, thanks, Willis. Any questions? No? Right, the committee has been asked to note the report and also approve the revised, am I looking at the right thing? Just wait a minute. Has been asked to approve the investment advisor objectives for 2025. I'm happy to move the recommendation. Can I have a seconder? All those in favour? Thank you. So the next item is the agenda item is town risk management internal controls. We're going to take this report as read unless anyone has any questions. Has anybody got any questions on it? It's fairly straightforward, yeah. The committee has been asked to note the report and approve the revised pension fund risk register. I'm happy to recommend it. Can I have a seconder? Yep. Thank you. All those in favour? Thank you. That's unanimous. Yeah. Okay. Right. Before we address the climate risk register, we're just going to have a very quick 5-minute break. So we'll be back, say 8 minutes past. All right.
Yeah.
Yeah. The final substantive item in the public part of the meeting is the Climate Risk Management Report 2024 and the Responsible Investment Update at pages 113 to 184 of the agenda. Kat Chui, Responsible Investment Analyst, is presenting the report. I'd also like to welcome Mr. Afzal, Mr. Sala and Mr. Galbraith from LGPS Central, who will be assisting this morning. Kat, please go ahead.
Thanks, Chair. I'm going to try and take this in section by section. So I'll go over some of the high level areas, and then we'll just hand over to Central, and then we'll go back to some of the areas where we need to focus on that need your approval. So as a reminder, and for members not currently who weren't at committee at the time, so the committee agreed a net zero climate strategy back in March 2023. This followed extensive consultation with scheme members, employers and other stakeholders. And we ended up with the net zero climate strategy that the committee approved, which sets out really strong targets. So 9 targets, including net zero by 2050, with an ambition for sooner, and other targets which kind of report goes into, which were all based on best practice from an institutional investors framework, and also kind of the direction of the committee and our stakeholders. This was all in recognition of climate risk and considering climate risk as part of the fund's fiduciary duty, managing those transition risks and as well as the physical risks. So this is the fund's 5th climate risk management report. This iteration builds on last year's and all the kind of comments and discussions that committee have had this year that I know some members kind of fed back into. So this report goes into a lot more detail on kind of engagement cases and kind of why some of the metrics are changing in terms of performing better or worse. I think really positive, and I think we were surprised to see how well the fund has done, and kind of it's really overachieved its target so far. So the fund's achieved its both of its primary interim targets, and they were targets which we said we'd achieve in 2030, but we've already reduced our weighted average carbon intensity by 50% versus that 2019 benchmark, and that is kind of a proxy for considering the fund is less exposed to carbon price risk, something that comes in globally in future. We've also reduced our finance emissions by 40%, and that's the kind of emissions that the fund is responsible for our ownership in companies. So that was something we saw as really challenging, just because we know our assets under management will increase. Therefore, your emissions should increase alongside that. So really positive to see we've met that target. Alongside that, the fund's got over 20% invested in climate-related investments. So not only across equity, but debt, infrastructure and forestry. And that doesn't even kind of start to include the kind of climate positive investments within other asset classes, which don't have a climate linked mandate, but are investing in that way in any case. This is the report with the first year we've included private markets. So we're increasing our assets under the kind of scope of this report, and kind of hope to do that over the years ahead. But this is still ahead of the net zero of targets and our schedule. So lots of positives to take from that. And I think, as you kind of heard in the first report today, this is against the backdrop of the fund that is, it's overfunded and it's kind of performing positively. So we're getting all these climate benefits while the fund is performing well in line with the fiduciary duty. I think it's important to say that this progress wouldn't have been possible without committee's strong guidance. Those kind of key investment decisions around climate multi-factor funds and the low carbon transition fund, I think, has really set the fund on a trajectory alongside the net zero climate strategy. While we say this, I think it's important to be realistic. I think that we're not expecting this performance to be linear. These are some of the kind of the easiest carbon reductions that we've been able to make through asset allocation decisions. So when we come on to future asset classes, these will be kind of more challenging asset classes, and they don't all have kind of climate opportunities in the same way that equities do, or some of the other kind of asset classes we're diving into. But at this point, I'll hand over to Central, and they'll kind of go over the report a bit more.
Okay, thank you, Kat. So, gentlemen, please proceed.
Thank you. Good morning, everyone, and thank you for your time today. Kat has done a really good introduction for us, so I'm sorry for any repetition you might hear throughout. As you mentioned, my name is Alex. I'm joined by my colleagues Samid and Basha. We work in the Responsible Investment and Stewardship team, with Basha overseeing responsible investment integration at LGPS Central. And we are the team who have put together our Leicestershire County Council Pension Fund's 5th iteration of the Climate Risk Management Report. Just to say, we will have time for questions at the end, but I realise we're covering quite a lot of content, so please feel free to stop me at any point and ask any questions you might have. And just to note, I might refer to Leicestershire County Council Pension Fund as just the fund. So if I do that, just to clarify any confusion. So moving on to the agenda for today, which is slide 2. Yep, thank you. We've split it into 3 sections. Firstly, just to highlight the executive summary and some of the biggest takeaways from the report. And then also looking at actually introducing report, some of the enhancements we've made from one year to the next. Section 2, we're going to be introducing or reintroducing a lot of the climate metrics, the best way to interpret these metrics, what they mean, their use cases and their limitations. And finally, I'll hand over to Samid, where we're going to actually have a look at the climate metrics applied to the fund and what is driven where these metrics have moved. So moving on to section 1, and I'll pass to Samid to give a summary of the executive summary.
Yeah, good morning, everybody. So just to touch on some of the high-level points in the climate report, as Kat mentioned, there was some really positive progress against the fund's primary targets. So there's a 40.4% reduction in absolute financed emissions, which is against the target of 40% by 2030. Carbon intensity has also decreased by 52.8% against the target of 50% by 2030. Like Alex mentioned, he'll talk through a little bit more in detail what those metrics mean. The fund also has implemented secondary targets which focus on supporting kind of real world decarbonisation, and again we see some relatively strong numbers and figures there. So 64.2% of the portfolio's net asset value in material sectors is considered to be aligned or aligning to the Paris Agreement as determined by LGPS Central's methodology. And 75.7% of the equity financed emissions are considered to be aligned or aligning to the Paris Agreement or are under an engagement program. And then apportioned by revenue, the fund's equity holdings has increased its exposure to clean tech while reducing exposure to fossil fuels. Looking at it through an absolute measure, so absolute exposure to clean tech has actually increased by approximately 4 percentage points. And fossil fuel exposure has also increased by approximately 1 percentage point. Just a bit of a nuance there with the fossil fuel exposure is that increase is generally due to greater exposure to Berkshire Hathaway, which derives less than 1% of its revenues from fossil fuels, but has quite a large exposure in the Climate Multi-Factor Fund. I just wanted to mention that I think it's important to recognise that achieving net zero requires real world decarbonisation, and as responsible investors, ESG integration, engagement, voting, advocacy are all tools that we can use to kind of influence the economy towards that kind of real world decarbonisation. And that really decarbonisation is not a linear trajectory, and that emissions in your portfolio can fluctuate over time due to a number of factors. I'll let Alex run through the next few slides.
Thank you. So let's move on to the introduction and report enhancements. Just to give a kind of overview of the purpose of the report and where it's come from. So as Kat mentioned, this is the 5th iteration. So we first started doing this and carbon footprinting on the fund's behalf back in 2020. The structure of the report changed, trying to move alongside industry best practice, but the 4 main pillars remain the same. So this follows the pillars of the Task Force on Climate-Related Financial Disclosures, or TCFD, and this looks at governance, strategy, risk management, and metrics and targets. And ultimately, this report goes to the fund, and it's designed to help set up the climate strategy, the net zero climate strategy, and also be able to provide the metrics that goes into the documents, such as the TCFD reporting. I just want to now talk about, if we move on to the next slide, the kind of enhancements and the amendments we've made to the report from last year to this year. If you remember last year, we were considering the recommendations which came from the Department for Levelling Up Housing and Communities in their LGPS TCFD consultation. So this report contained several recommendations which weren't mandatory but could be made mandatory in the future. So we consider that as a kind of benchmarking for a gap analysis. We also then focused on looking at what is considered industry best practice. Considering those recommendations haven't changed, considering that the industry best practice hasn't changed significantly year on year, and also the fact that the recommendations we gave last year, it's just simply not feasible for all of these recommendations to be acted upon in the space of a year. We've now shifted our reporting to being more aligned to that of TCFD to try and help with the TCFD reporting of the fund. We've also made some other enhancements in the report. As Kat mentioned previously, we've now included the private markets data, that of what LGPS Central manages on behalf of the fund. We've also got metrics specifically for sovereign debt, which was previously uncovered. So that's about 10% of listed assets that wasn't previously carbon footprinted, but now is. And we've also, from feedback of our partner funds, including Leicestershire County Council, we've incorporated some other aspects of the reports, such as in the risk management section, we've focused a bit more on the engagement aspects, as well as in the governance section, we've altered up that section as well. So if we move on to section 2, if there's not any questions so far.
Bill.
Yeah, thank you. Thanks for that. So the first question is, we've had the US election and President-elect Trump has made it very clear that he's going to withdraw from the Paris Agreement. And just thinking about global investments, we're investing globally. The US economy is a massive driver of the global economy. And I'm just wondering if the incoming president scraps their participation in that, lifts all the investment, the bans on them doing more liquid gas, fossil fuel exploration, etc., etc. I'm sure you fully well know all this. What effect does that have on our investment strategy going forward? Because I can see there'll be a lot of opportunities for growth in the US and elsewhere, and we'll be turning around to ourselves saying, well, that doesn't meet the climate reduction thing, so we won't invest. And I'm a bit concerned about that. I've always been a bit of a, shall we say, skeptic on this matter, because I'm not entirely convinced. Climate's always been changing for thousands of years. It's colder now than it was 10,000 years ago. So I'm just kind of, curious as to what you think the impact of Trump getting elected is going to be on the validity of the Paris Agreement, or whether it's actually going to stand up post January the 20th. Thank you.
Thank you. I think when Trump first got elected 4 years ago, well, not 4 years ago, 8 years ago, he did pull US out of the Paris Agreement, and he's threatening to do that again. So when he did that in his first term, very minimal impact to how other countries in the world views climate change. Ultimately, as an investor, our job is to identify, assess, and identify, assess, and manage any risk, ESG or any financial risk, inflation risk, or whatnot within our investments. And we've highlighted climate as a potential risk to our investments. What we do is we have to assess how the market works and what the world does going forward. I don't necessarily think that the world will reverse its course. I think there's still very, very strong commitment from most countries, even some US states that is seen as red. They are the main beneficiaries of the Inflation Reduction Act, which is very much on green spending. So I don't necessarily think that Trump will cut those benefits from these red states, because it's very beneficial to them. So there will be pockets of opportunities to invest, and there might be a bit more investments in oil and gas, which may be beneficial in the short term. As an investor, you'll have to assess whether it fits into how you want to invest and whether it fits into your long-term investment horizon and long-term investment returns.
Thank you. Thanks very much, Bata. Right, so carry on.
Thank you. So just to give a quick overview of some of these headline metrics. So this first looking at the finite emissions, normalized finite emissions, and weighted average carbon intensity, or WACC. Just to highlight the two of these, so finite emissions and normalized finite emissions, these did come from the recommendations of DLUC. They did have to kind of see these type of metrics, so an absolute measure, an intensity measure. Starting with finite emissions, the best way to interpret this is if you were to own 1% of BP, you would be responsible for 1% of BP's emissions, and then you can aggregate up that for the whole portfolio. So this is a really good measure to kind of see what is our absolute carbon footprint. However, there is a sizing issue. The fact that if you put more money into a fund, your ownership of companies is going to increase, and therefore your attribution of those emissions is also going to increase. So a way to overcome that is by looking at normalized finite emissions. So this takes the finite emissions figure and then divides it by millions of pounds invested. So this has the benefit of now, if you wanted to compare one portfolio to another, they've both been normalized, and that allows for that. Another intensity metric is the weighted average carbon intensity. So I'll just break that down and look at the carbon intensity first. So this takes a single company, it will look at the emissions of that company and then divide that by the millions of dollar revenue as a kind of sizing factor for it. From that carbon intensity, we then use the portfolio weights, and we can use that to have a weighted average of the carbon intensity, hence weighted average carbon intensity. And again, this also provides a normalized metric that you can then use to compare one portfolio to another. It's a really strong indicator of how exposed is your fund to carbon intensive companies or climate risk. For the two intensity metrics, it should be noted though, unlike finite emissions, they won't provide a kind of absolute footprint figure for you. Hence why it's quite important to have not just these three metrics, but a whole suite if you're going to have a true understanding and a full picture of the climate portfolio. I move on to the next slide. So this is LGPS Central's Paris alignment methodology. So again, following the DLUC recommendations and the consultation, it included a recommendation to have a measure of Paris alignment. So it should be noted that there is no universally accepted, this is what Paris alignment looks like, and this is what a Paris aligned company looks like. So we produce our own proprietary metric using the underlying data provided to us by MSCI. And we've been quite stringent with this. So it's quite difficult for a company to be considered Paris aligned through this methodology. This includes a backwards-looking metric of the low carbon transition score. So if a company is more exposed to climate risks, this pulls down the score. And if they better manage the risks, it pushes up the score. So this ranges from 0 up to 10. And we look for a score that's at least above 5. We then have 2 forward-looking metrics in place. We want to see, does the company have a verified medium and long-term science-based target? And also, does the company have an implied temperature rise below 2 degrees by 2100? And what we then require is the company has to have the low carbon transition score of 5 or greater, sorry, greater than 5, and at least one of the 2 forward-looking metrics to qualify as a Paris-aligned or aligning company. So next up is data quality and availability. So again, sorry, you'll get sick of me saying this, but this is a DLUC recommendation to have included, but we did have these kind of metrics in prior to that consultation. But this provides a really strong understanding of how accurate is your overall aggregated metrics for your portfolio. And as you can imagine, if you receive more reported data and less missing data, those aggregated data is going to be more reflective of the true carbon footprint of your portfolio. And you can just see here, so this is for the fund's equity data availability, so it's listed equity data availability. You can see it's risen pretty substantially over time, going from missing and unavailable to more reported data. And that's at, if you round up to 95%. So really pretty strong reported metrics coming in. So therefore quite accurate data that you're going to be seeing at the portfolio aggregated level. Moving on to the exposure metrics. So there's 3 sources of exposure that we look for, what we've included here: fossil fuels, thermal coal, and clean tech. And there's 2 ways we can look at exposure. The one being absolute exposure. So this considers, does the portfolio have any exposure to one of these sources? If so, all of the portfolio weight is considered to be exposed. We realized, I think it was back in 2022, maybe slightly earlier, that a more nuanced approach is maybe more appropriate. So then we broke it down by apportioning by company revenue, and then that's portfolio weight, and then aggregating upwards. So as Samid mentioned earlier, the company Berkshire Hathaway, pretty large passive exposure. The actual exposure to fossil fuels is less than 1% by revenue. So because of that reason, we think it's often more appropriate, and for the purpose of the targets in place for the fund, more appropriate to look at the proportion by revenue. Moving on to sovereign data. So this is some of the new metrics we've included this year. This has been possible from the fact that the Partnership for Carbon Accounting Financials have now started putting out methodologies for how you should look at your sovereign data exposure through a climate lens, but also the fact that the underlying data providers, so for us that's MSCI, they've actually started providing the data required to apply these methodologies to our holdings. And as I mentioned earlier, this now accounts for 10.8% of the fund's listed holdings. So this is now carbon footprints we previously hadn't provided or couldn't provide and now have provided. Similar to how we look at the corporate side, we've got financed emissions, and we look at that through production, and weighted average carbon intensity, and we look at that through consumption. So if you move to the next slide, Anton is quite wordy, and I just want to provide more of an intuitive understanding to what these metrics actually mean. So for the financed emissions, this looks at the emissions associated with a country's production. So for everything that's produced, what are the scope 1 and 2 emissions associated with that? Similar to the corporate holdings, we attribute that to our exposure. So for the sovereign side, this considers what is the NAV, and then that's proportioned by the GDP of the country, adjusted for PPP, which is a kind of inflation adjustment. For weighted average carbon intensity, we look at consumption. So this is the emissions associated with the consumption of goods and services in the economy. And then instead of using revenue as a normalizing factor, we use the population of the country to normalize that. We haven't got slides, but also to add, we do have the private market data in Appendix 1. The metrics included to that are aligned to that of the corporate data. So the way we've defined them previously can be defined for them as well. I realise I've gone quite quick through them, so I don't know if there's any questions or...
Has anybody got any questions? Oh, James.
Thank you. I suspect this is in the data or kind of more widely known, but I'm relatively new to the committee. You talked about the two measures absolute in terms of exposure to carbon, and we've talked about Berkshire Hathaway, which is indirect via a fund. Do we have direct exposure in terms of listed equities to fossil fuel extraction?
Yes, there will be. So we've also got a climate stewardship plan, and this tries to single out several companies and a couple of factors, including one, the exposure to the company, two, our ability to influence change, and also their contribution to finance emissions. So that will include the highest emitting companies. So that will include the oil and gas companies. And this list of companies is where we try to focus our engagement on the most, to try to obviously reduce these emissions and also encourage the company to put more capex into clean tech and that sort of thing as well. Thank you. So I'll pass over to Samit for section 3, which looks at the climate data but applied for the fund.
Yeah, thanks, Alex. So yeah, as Alex mentioned, I'm just going to touch on some of the more analysis of the report and then bring a few engagement examples to life. So on the equity finance page, yeah. So as we mentioned previously, we're pleased to report that as of Q1 2024, financed emissions have reduced by over 40%. This is alongside a 29.2% increase in net asset value over that same period. And when we look at that compared to the reference index, it's a 39.2% reduction in financed emissions. Looking through the lens of normalized financed emissions, this has decreased by 58.1% versus 2019, and then compared to the reference index by 46% reduction there as well. So before looking at some of the drivers of what's driving these emissions reductions, I'll just have a quick look at the WACC, or the weighted average carbon intensity. And again, we're pleased to report that there's a 52.8% reduction in WACC versus 2019, and against the reference index is a 45.4% reduction. Moving on to some of the drivers. So there's really two key things that's driving these emissions reductions. Firstly, asset allocation decisions, as Kat mentioned, and then also kind of the lower exposure to carbon intensive companies. So the fund is actually invested in LGPS Central's low carbon multi-factor fund, as well as LGIM's low carbon transition global equity index fund, while exiting some of the higher carbon footprint funds, which has contributed to kind of the overall decrease in the carbon footprint. In terms of exposure to carbon intensive companies, the most carbon intensive sectors within the portfolio, like utilities and materials, experienced decreases in their weighted average carbon intensity by roughly 45 and 39% respectively. And this effect was compounded by a decrease in portfolio weight of 1.6 and 2.6% respectively. And then just broadly speaking of some of the drivers of kind of decarbonisation in the utility sector, you look at things around increased renewable energy adoption, which has been accelerated by things like the Inflation Reduction Act, which was alluded to by Basha, investments in grid modernisation and the general push for electrification, which has allowed utilities companies to support the development of critical infrastructure like EV charging, and kind of the electrification of heating systems. In In terms of some of the drivers in the material sector, we look at things like adoption of low carbon technologies, such as electric arc furnaces, to lower emissions in the steel production process. Alternative fuels being used and improvements in kiln efficiency when it comes to cement production, and the increased focus on kind of circular economy practices. So moving away from the emissions associated with kind of virgin material extraction. And then drilling down to the company level, so we call out Shell, Holcim and CRH, which have experienced reductions in their absolute scope 1 and 2 emissions. All these companies are in our stewardship plan, so we engage with all these companies directly. So at Holcim, they're well on track to meet their interim decarbonisation targets. We wrote to the company recently. Our engagement will focus on kind of gaining reassurances around that the board is sufficiently competent in with respect to kind of overseeing climate risk and opportunities. At CRH, they are considered aligned or aligning to our net zero strategy. And we met with the company a couple of weeks back to discuss their use of coal and Paris aligned accounting as well. On the next slide, so this is just about Shell, our engagement history with Shell. I just wanted to bring this to life a little bit. They're responsible for 4.3% of the fund's total equity financed emissions. And we've engaged with them directly over the past few years. They're also engaged by our stewardship provider, which is EOSAT Federated Hermes, and LAP, the Local Authority Pension Fund Forum. So back in 2022, we sent the company a letter. We sent a letter to the chair outlining our rationale for dissenting at their AGM, specifically on their kind of energy transition strategy. Our concerns there were kind of the concerns around the capex, alignment with a 1.5 degree scenario, as well as robust targets that would facilitate the achievement of their 2050 net zero target. Following that letter, we met with the company to discuss our kind of rationale for dissent in further detail. In 2023, again, we met with the company to discuss Scope 3 absolute emissions targets and its refreshed energy transition strategy. And we also submitted evidence to Client Earth to kind of support their litigation against Shell. In 2024, this was kind of the first year of our refreshed stewardship strategy. And for each of the engagements we have, we set kind of defined objectives. So for the kind of long-term objective with Shell is to ensure that the company's energy transition strategy is Paris aligned. We also have a shorter-term objective, which is kind of about relationship building with the company, and really to understand when the interim climate targets will be released. So this was after Shell scaled back its climate targets, including dropping its 2035 carbon intensity target. And we actually voted against the energy transition strategy at this year's AGM. Our main points of concern were, again, around that removal of the 2035 carbon intensity target, alignment of CapEx with its 2050 net zero ambition, and the rather bullish assumptions of its kind of future gas prices and demand, which is kind of overstated compared to the International Energy Agency. And so we wrote to the company outlining our concerns, and in September we met with the chair, and they actually really kind of confirmed that they are pretty much all in on gas, that they don't particularly want to be aggressive in the renewable space because they don't feel like they have the expertise in that space. And from the company's view, LNG is a really good bet because it acts kind of as a transition fuel, helping kind of developing economies kind of wean off coal, and that they want to be more involved in the build out of gas infrastructure. So think about things like pipelines and kind of the transportation of LNG. And then finally, that we can expect the interim climate targets to be released in the next few years. In terms of kind of future action on this engagement, we really just want to gain clarity over what Shell's plan is for their if their kind of gas demand predictions are overstated? What's the backup plan? We also recognise that the company kind of pays a strong and stable dividend and has done for years. So one of the potential asks for that engagement could be around them to report on their dividend resiliency in the context of climate risk. So under different temperature scenarios, how does that affect Shell's ability to pay out a strong and stable dividend? And we'll continue to kind of collaborate with our manager on this engagement. So we have a meeting booked in with them in a couple of weeks to discuss that further. I also just wanted to touch on the recent litigation with Shell, which has been in the news. So Shell recently won the case in the Hague Court of Appeal, which overturned their requirement for Shell to reduce its emissions by 45% by 2030. So originally the court had actually reached a conclusion that Shell had an obligation to protect claimants' human rights as part of complying with the implied standard of care contained in section 162 of the Dutch Civil Code, and that this involved an obligation to actually limit human rights impacts associated with climate change. Shell appealed this, and the Court of Appeal actually found that whilst Shell does have an obligation to counter the effects of climate change, its obligation under the social standard of care under Dutch law does not amount to a specific emissions reduction kind of percentage. So originally it was 45% by 2030. So the court said you have to drop that, and you can't really require Shell to reduce their emissions by a particular percentage by 2030. This is after so the court actually recognised that a 45% reduction in CO2 emissions is required by 2030. So that's very much in line with scientific consensus. However, that's a global target, and that cannot be applied to an individual company because they recognise that individual sectors, companies and countries will have to reduce their emissions more or less depending on the nature of the entity. And really, the Court of Appeal has a very similar position to us, that companies should feel free to choose their own approach to reducing emissions as long as they are consistent with the Paris Agreement. This has been our position and kind of will continue to be so. And one final thing I wanted to raise on this was that the Court of Appeal also considered the United Nations Guiding Principles on Business and Human Rights and the OECD guidelines for multinational enterprises, which many companies endorse, including Shell. These instruments actually explicitly and implicitly link corporate responsibility in respect of human rights impacts and climate change. So for future kind of litigation or claims, we could see those claims leaning more into those instruments of the UNGPs and the OECD guidelines. So just moving on to the next slide then, sorry. Fixed income financed emissions, so they've increased by about 179%. This has largely been driven by a significant increase in the asset value, which was by about 196% compared to 2021. Viewed through the lens of normalised financed emissions, they've actually decreased by almost 30% compared to 2021. And then moving to the next slide, looking at WACC, so that's reduced by 46.9% versus 2021, and compared to the reference index, it's a reduction of 23.6%. Looking at some of the drivers then on the next slide of what's driving those is, again, asset allocation decisions and kind of that exposure to carbon intensive companies. So during 2021, the net asset value grew quite significantly, which was attributable to investments into two of the corporate bond funds. This increased net asset value, which drove up financed emissions. But when you view it through the lens of normalised financed emissions, that kind of metric decreased. So the materials and financial sectors make up a significant proportion of net asset value. They actually experienced a significant decrease in weighted average carbon intensity of 48.1% and 46.1%. And some of the contributors to the decrease in the financial sector are kind of the general, especially for the European banks, divesting from fossil fuels and investing more in renewable energy. and the integration of climate risk assessments in the investment decision-making process. And then we call out here CEMEX, that's the fund's largest contributor to fixed income emissions. And that's decreased by around 7.4%. They're actually quite a good company. They're ranked first in the World Benchmark Alliance's heavy industries benchmark. They're aiming for about a 23% reduction in Scope 1 and a 58% reduction in Scope 2 emissions by 2030. This is in line with a 1.5 degree scenario, which has been validated by the Science Based Targets Initiative. And again, they've been prioritised as a company for Central to engage with. That engagement will focus largely on kind of the CapEx linked to decarbonisation projects versus the traditional emissions intensive projects, as well as kind of transparency around research and development investments as well. I think that's it for the slides. So I'd be happy to take any questions or comments, feedback.
So has anybody got any questions that they'd like to ask Roy?
Yeah, moving assets between going into assets that are very good in this sector helps the fund improve. But I'm encouraged that the advocacy point of your activities to the people who are not performing well is better in terms of the country as a whole, because you're driving things down. Betty Martin's not here today because I think he'd be reassured, because we have colleagues who very much want us out of fossil fuels, etc. But I take comfort from the fact that you're in there and you're talking to them and you're trying to drive them forward. So I'm pleased on that department at least.
Any other questions or queries? No? Okay. Matt, have you got anything else you want to add?
Yeah, I'll just briefly, because obviously there's a lot in the report, but obviously the time, I'll kind of just try and do the key points. I think I just want to take committee back to the point on the absolute reserves metrics. So in the report, in the cover report, I think it's on page 116, paragraph 17, 18 and 19, we're proposing, to take us back, we've got two secondary targets which relate to reducing our exposure to fossil fuel reserves within the equity portfolio and also increasing our exposure to climate solutions within the equity portfolio. When these targets were set, they were set using those absolute absolute exposure metrics that they reference. So we're having the issue with the Berkshire Hathaway on the reserves metric, but we're also seeing a kind of a similar issue with the climate solutions exposure. So this year, it kind of has our exposure as 42.7%, which looks great, but probably isn't realistic of the actual impact. What we're proposing is for the net zero climate strategy, how we primarily measure it, we switch to the by revenue metric, which kind of gives a better attribution of these targets. We'll still continue to measure the exposure metric and report it back to committee. I think just for the ease of how we communicate our targets, I think it's a lot better metric and it's improved on what we had back in when we set the target. So it's an improvement on that. Does anyone have any questions on that piece?
I think carry on, Kat.
I won't spend too much time. I will also just bring your attention to the climate stewardship plan. So that is on paragraph 34. So within the appendix, we're proposing to change the companies that the fund focuses on for the climate stewardship plan with Central. These fairly simple reasons, but I just want to make sure you're aware before kind of you make the decision. Primarily, we want to remove Anhai Conch Cement and then NextEra. So Anhai Conch Cement is no longer within the portfolio, so there's no point it being on the list. And NextEra has now fallen to 54th top contributor, so nowhere near the kind of size of the companies in the table on paragraph 36. And then we're also just recommending including CRH, which kind of references a kind of a top emitter. Also, just to highlight, we did some fund benchmarking, so you can kind of see on points 40, 40, how Leicestershire's weighted average carbon intensity compares to other funds. So all of the wackies that I can find in the public domain, there's only 2 as of when I took this that are performing better. So LGPS-H and LGPS-C. I didn't want to create a kind of league table within the report because I think there's a lot of caveats within the data. So a lot of different kind of data providers and when they would take the snapshot that compare it. But of the funds that are doing better than us, they're taking the exact same actions that we are. So they're making the same type of equity decisions in terms of those kind of climate related investments. And then the report kind of goes on to some of the wider climate considerations. So obviously the report goes into our equity and then also our LGPS central holdings and some of our external managers, but we still have about 50% of the portfolio that's not within the climate risk management report. So there's quite a lot in the report kind of focused on those. So if there's any questions on those areas in particular, happy to take them, but otherwise kind of assume you'll have read through them. I think that's kind of any questions on anything else, happy to take it.
Thank you, Kat. Has anybody got any questions now? Right, well, thank you, Sameed, Alex and Asab. Appreciate your input as well as you, Kat. Thank you. And it's a very comprehensive report, quite detailed. So, David.
Congratulations to the team, both local, our own team and the central team for what they're doing. We really are. There are so many challenges around. As Phil has mentioned, the US are now seem to be backtracking with Mr. Trump talking about drilling in the Arctic and all the rest of it. And the COP conference only just about reached a satisfactory conclusion. And of course, we're all still dependent upon oil coming in from unstable parts of the world and parts of the world that we would rather not have any investment in at all. So there are a tremendous number of challenges around, but I think we are as a team here with everybody else working on this, we are moving in the right direction.
Thanks very much. I think that's true. I think we're seeing the progress we've made. It's something we can be proud of. So the committee has been asked to note the climate risk management report progress versus the responsible investment plan 2024, quarterly voting report, stewardship activities, and the high-level overview of the fund's investment managers' net zero approach. B, to approve the proposed changes to the climate stewardship plan companies as set out in pages 35 to 36 of the report. Approve the proposed changes to the primary focus of the climate solutions and fossil fuel measures to buy revenue within future reporting as set out in paragraphs 17 to 19 in recognition of the rudimentary nature of the metrics as set out in the net zero climate strategy. Give further consideration to appropriate metrics as part of the review of the net zero climate strategy throughout 2025 and 2026. I'm happy to move the recommendation. Can I have a seconder? Thank you. All those in favour? That's everybody. So the date. Thank you, gentlemen. Thanks for your. We've still got a little bit more. I think we still need you. So date of next meeting. Members are asked to note the date of the next meeting, which is the 31st of January 2025. Members are also reminded that the Pension Fund Annual General Meeting will take place on the 9th of December. Item 13, there are no urgent items. We now come to the exclusion of the press and public. I move that the public be excluded during the consideration of the remaining items in accordance with Section 100A, subsection 4 of the Local Government Act 1972, exempt information. Is that agreed by everybody? Yeah. Okay. That brings us to the end of the public part of the meeting. The live stream will now end.